Cap rate or cash flow? Which one is more important when analyzing an investment property? You probably just attended one of those weekend real estate seminars. You know what I'm talking about. The ones where everyone's talking about cap rate and cash flow jargons. Or you're probably just analyzing a deal yourself, but you can't seem to figure out which approach or which method you should take. Or maybe you're in a coaching program and your coach handed you a pro forma, spreadsheet, or a calculator to analyze a property. Or perhaps a joint venture partner is asking you to invest your money, but you have no clue how they arrive at their numbers. Or you just want to look good or look smart and impress an investors by showing that you know how to analyze a property to see if there's money in the deal. Sounds familiar? If any of this sounds familiar, buckle up because in this video, I'm going to break it down the difference between cap rate and cash flow, the pros and cons for each, and when to use them so you don't end up wasting time and money on the wrong deal. So let's start with the cap rate or capitalization rate. What is a cap rate? A cap rate, short for capitalization rate, is a common metric in real estate investing used to estimate the potential return on investment of a property. Cap rate is a quick way to measure a property's return based only on its net operating income and purchase price, ignoring financing. A simple formula for cap rate is net operating income divided by purchase price, and that will give you a percentage number that will signifies if the property is sound investment or not. For example, if a property generates $20,000 net operating income a year and it costs $400,000, the cap rate is 5%. Now let's talk about the pros and cons. The advantages of a cap rate is it is easy to compare properties across market. It tells you how efficiently a property produces income before considering debt. And it's great for evaluating buildings, multifamily, or when comparing properties in different market, different price ranges, and different areas that do not have a comparable to compare it with. Now let's talk about disadvantages. The disadvantages of a cap rate is it doesn't consider financing, taxes, or your personal expenses. So if you're looking to finance a property, that number may be skewed. A high cap rate might look good, but could also mean a higher risk. Example, bad locations, deferred maintenance, unstable tenants. Remember, if you have a year where you have a higher operating expenses, the property might not show its true potential. Now let's talk about cash flow and the importance of a cash flow in real estate investing. What is a cash flow? A cash flow is a money left over after all expenses and financing are paid. In simple terms, rental income minus operating expenses minus mortgage is equals to cash flow, the money that goes to your pocket. For example, if a rent brings in $3,000 a month, expenses are $1,500 and the mortgage is $1,200, your cash flow is $300 a month. Now let's talk about the pros and cons of a cash flow in real estate investing. The advantages of a cash flow is it shows what actually goes into your pocket every month. It helps you plan for reserves, emergencies, or reinvesting or scaling your portfolio. It is vital if you want properties that pay you consistently. Now you may ask, what's the disadvantages or weaknesses of a cash flow? The disadvantage of a cash flow is it is highly dependent on financing structure. For example, loan terms, interest rate, down payment. It is harder to compare properties directly since two buyers can have totally different cash flow depending on how they finance it. So when to use each method? When should you focus on a cap rate and when should you focus on a cash flow? You use a cap rate when comparing properties in the different markets that do not have comparables. Evaluating buildings without financing in mind, like commercial or multifamily. When analyzing properties that do not have an available comparables to compare it with. You want a quick snapshot of a return based on a property's performance. You use a cash flow when you care about monthly income. You're looking at analyzing the deal with your financing in place. You need to know if the property will cover expenses and will pay you. Think of it like this way. Cap rate is equal to property's performance. Cash flow is your personal performance. They both matter, but which is more important depends on your investing strategy and goals. If you're building wealth in the long term and comparing properties in multiple markets, cap rate matters more. If you need monthly income and stability, cash flow is a king. So at the end of the day, it's not about cap rate versus cash flow. It's about knowing when to use each tool. A smart investor look at both because cap rate tells you if the property is efficient and cash flow tells you if the deal will work for you. If you find this helpful, don't forget to hit that like button, subscribe for more real estate investing tips, and drop a comment below. Do you personally look at cap rate or cash flow first when analyzing a deal? Thanks for watching, and I'll see you on the next one.